Santosh, I want to start with you and Apple and Trump's revised tariff plans there, Santosh. Here's how Angelo Zeno over at CFRA, here's how he put it, Santosh, told his clients, Apple is clearly the biggest winner across the technology space, avoiding a worst case scenario. We view the temporary exemption as going a long way toward providing better visibility and no longer expect drastic revenue and EPS revisions to our forward estimates. Santosh, you hear that analysis. Does it make sense to you?
Absolutely. Great to see you. I think Apple had the biggest to lose, had the most to lose in this whole fight. I think this gives them time, gives them 90 days at least to kind of regroup, get their supply chain together while the atmosphere de-escalates. Maybe there's fruitful outcome of this trade negotiations with China. Hopefully, that's a long shot, but hopefully something good comes off it. But they have 90 days to really figure that out. So that's a good one. That's a big help. And so overall, I would say, I agree with the analyst there that they are the biggest beneficiary. It benefits others as well, but more so for Apple because their iPhone comes from there and that's their biggest growth engine. So I think they don't want that disrupted, but they need to move fast and they need to be strategic. And that's the whole idea. And they get the time to do it. So that's good.
Santosh, Adam here. I totally agree with you. It makes perfect sense that Apple would be up on getting a break from tariffs. What I can't figure out, maybe you can help us understand it, is NVIDIA. Right now they're going to build chips and AI platforms here in the U.S., so certainly tariffs aren't going to be relevant for them once that's up and running in a year. And yet the stock is barely up today, maybe 0.5%. Can you help us understand why NVIDIA isn't up more?
Yeah, I think NVIDIA has a lot of other things going as well. There is this suspicion that AI has run its course, things like that. Maybe people have already got their chips already. So things like that. Then we had DeepSeek, and there's some alternatives to NVIDIA. Maybe you can do things cheaper and faster in some other ways. So that total dominance of NVIDIA is being threatened, though I don't believe that. NVIDIA is still the major player. You need them for everything from robotics to cars to everything else. They are the core piece of all the things that are going on or that are coming down the pike. So I don't think NVIDIA is at risk, but on the face of it, I think there is a risk. There is that feeling that maybe it's not smooth sailing. They're going to they need to do some reinvention and be ahead of the game. So there are some challenges ahead. So they had other issues going as well. And NVIDIA is playing the tariff game pretty well. They're well positioned. They're already in Arizona, and they agreed to spend $500 billion. I think that's great as well. So I think they're doing the right things. So I think they're okay. But overall, I think AI, the whole setup around AI is kind of not as smooth as it was before.
Santosh, I'm curious, as you roll into earnings season now, and we start hearing from these chip companies, do you think, Santosh, we're going to hear from chip companies, they're going to tell us a lot of their chip customers stocked up on chips, kind of pulled forward demand ahead of those tariffs?
Yeah, we're going to hear some of that, a lot of it. We don't know exactly, but I think definitely that was the sign that people have pulled forward. And even from China itself, and a lot of things happened there as well in terms of pulling forward and all that stuff in terms of the export-import imbalance there. So you are going to see some of that. But I think fundamentally, I believe that AI has still a long ways to go. There is tremendous demand. Maybe there's some reorder in terms of who's leading it and who's not. And maybe the competitive landscape just got wider, but overall AI is needed, and the companies that play it well will do well. And NVIDIA is right there in that whole space, though they'll have company going forward.
Santosh, let me jump back in here. Got a little pause, and I don't want to miss that opportunity. Microsoft owns, call it about half of OpenAI, which owns ChatGPT. But I feel like that's a pretty sloppy way to play it, right? Because Microsoft is so big and ultimately OpenAI is such a small fraction, even if it's going to be larger. What's the best way to play AI from your point of view?
Well, I think I would continue to play the chips, but I think as we move along, the graph is going to move more and more towards the application side. So I think you're going to see Microsoft and other Googles and all the other places that provide the applications, and a lot of startups that are in the wings that we cover, that we follow and we invest in, they're also coming up. So that's the best way to play down the road. In the near term, it was all about the infrastructure layer, the chip layer, the top layer, kind of get the frontier models together. But now it's going to be applications. So you're going to see a number of winners on that side, and let's see where that goes. But definitely the graph is definitely moving to the side, moving right and up as the applications take more and more shape. And we saw that during the internet revolution as well. In the 90s, you had initially you had all the infrastructure side, and then we got the Amazons and Googles and all the other applications, the pet.com and all that, all those come in. And you're going to see the same thing, number of applications, AI applications that will come to you pretty soon, probably in the next 1 or 2 years. If not, that's the maximum. I'm expecting 2026, you'll start hearing more and more success stories in terms of application providers.
Santosh, we started with Apple. I want to circle back to the iPhone maker. I'm curious, Santosh, how you see Tim Cook's manufacturing footprint evolving over time, Santosh. Would you expect to see a lot more iPhone manufacturing, for example, in India, as maybe Apple tries to mitigate these US-China tensions? I was struck by this stat. I don't know if you saw this, Santosh. Bloomberg, citing sources, says Apple's now making 1 in 5 iPhones in India. I'm curious, do you see that footprint there just continue to expand for Cook?
Absolutely. I think India is the first place to go, and it's been going on for a while now. We've heard that, and I was in India recently. I saw there's a lot of chatter about it, Apple, and how production is ramping up there as well. So I think you're going to see India as the first stop, but I think President Trump doesn't want that either. He wants everything to come here. So I don't know how much time he has in staying with India and building there. But in the near term, it was all about Vietnam and India. So I think India is definitely going to be the biggest beneficiary of building this. They have the manpower. They just need to build that infrastructure around that. And that's also improving. But all that takes time. You know, you need a lot of manpower. You need the technology, you need the retooling. So all that takes a lot of time. And India has the capability of doing it. It's going to take some time. But that's going to be the biggest beneficiary. That country is going to be the biggest beneficiary.
Santosh, let me ask you, what about domestic manufacturing, U.S. manufacturing of iPhones? In your opinion, is that financially tenable for Cook?
Well, you know, he has promised to do it. He's committed to spending a lot of money. It's going to take some time. The cost is definitely going to go up. iPhones are going to cost a lot more than made in China or India or other places. So yes, he'll come in if he's forced to do it. Hopefully there is some economic sense, and even President Trump comes to some kind of a off-ramp in terms of forcing everyone to come here and say, okay, strategically, you do there, you have an advantage there, but have something here, some percentage here. So I hope there is some kind of a compromise in there, because you really can't get everything here and expect to get cheap phones here. It's going to be an expensive proposition, at least initially. Down the road, maybe you get the scale and all that stuff. But initially, it's not easy to get everything over and expect to buy $1,000 iPhones or whatever the cost is right now, and see this and just expect to have that. It's not going to happen. It's going to take some time.
Santosh, always good to see you. Always good to have you on the show. Thanks for joining us.
Thanks for having me. Thank you.
Well, big brand retailers are set to face tariff exposure and shifting consumer behavior, but my next guest says Walmart is positioned well for the potential impact. For more, let's welcome in now David Bellinger, Mizuho America's Director and Senior Analyst. David, it is great to see you. So I think you know where I have to start, David. We've got to talk tariffs. I would imagine, David, your clients are asking you all kinds of questions. These Trump tariffs, what do they mean for the retail sector? What do they mean for the retail industry? What are the ripple effects we have to think about as investors? What are you telling them, David?
Hey, Jess, thanks for having me back on. And yes, this is a widespread issue. We've gotten a lot of questions over the past week or two about just what the tariffs mean here. And it's definitely a negative, right? You've got all this noise out there. Prices are clearly going up. But right now, we're hearing a lot that consumer sentiment has been weakening. And data from January, February was pretty mixed. It was somewhat negative. You also had a lapping of leap day last year. So a lot of noise in the numbers. We think March got a little bit better, and the start to April has been fine. Like, we've seen some stabilization here, but there's just a lot of noise out there, potentially some panic buying on the part of the consumer, and maybe some pull forward in demand. It just makes the picture a lot more unclear here. There's a lot of tariff exposure in the U.S. These are domestic retailers, but they do source a good deal amount of product from overseas, China, other parts of Southeast Asia. So we're not seeing companies overreact just yet. And we're trying to work through all of these pieces as they come in, and there's just not a lot of clarity out there.
Uncertainty is definitely the word of the day, Data. I'm curious though, I mean, when you look at retailers, do they look generally positioned to eat some of these costs, or no, they're going to pass it along to David and Josh? To your point, you look at the consumer sentiment surveys, it doesn't seem, like David, like consumers are they seem not in a great mood already. So I'm curious how much, if they do try to raise prices, what you think the reaction would be.
Yeah, there'll clearly be some demand destruction here. So prices go up, unit volumes tend to come down. And we haven't seen the prices get pushed through yet. The consumer is definitely aware of this, right? And talking to companies like Walmart, we were just at their investor day down in Dallas. It seems like they have the optionality not to push these through right away. And the bigger players, including them, Costco, Home Depot, Lowe's, they sort of have the optionality here. They can do it in a slow and measured way so as to not shock the consumer. But these companies are all wired to protect their margins, right? So you want to keep costs as low as possible while protecting your margin base. And that's definitely something for these larger scale players who can push back on vendors, maybe source from different countries outside of China, move their supply chains around quickly if needed to. And they try to make those guys absorb more of the cost. So me and you, we don't pay a 25% increase on a 25% tariff. Maybe it's halfway in the middle, and we absorb pieces here and there, and the consumer is able to eat this a little bit better than if there were no offsets in general.
Let's get to some specific picks, David. You mentioned Walmart. I saw that you initiated this one as an outperform, so you're a believer here. You told your clients delivering the complete package. What do you mean by that, David?
Yeah, thanks for the question here. So we see multiple ways to win with Walmart. So the biggest piece, you've got this core business that's really benefited from consumer trade down. And a majority of the share gains that Walmart's picked up over the past year or two, they've been upper income consumers. So that's been pretty well documented. You've got the Walmart Plus program where consumers pay $98 a year. You've seen a lot of people step into that. We think they have about 20 million paying customers. Also, Walmart, this story has become really about the alternative revenue lines within the business. And those are advertising, membership, which you just mentioned, and marketplace. And that those are the fastest growing pieces of the business. And they also layer in the highest incremental margin rate. So just think of Walmart, $700 billion global retailer. Company has been around a 4% operating margin. We see a path to get well north of 5%. And it doesn't sound like a huge difference, but on that revenue base, there's massive EPS potential. So if you're talking about $2.55 or so at the midpoint of their guidance range this year, you could easily see Walmart be well north of $4 per share. Investors want to pay a premium for that. This is becoming more and more visible. And then one last piece here, you've also got what we think is somewhat of an overlooked Sam's Club business. It's very similar to Costco. We think they have about 30 million members, and those are powering a really nice, highly incremental margin into the overall mix of the business. So it's not just the core Walmart. They've got plenty of other drivers as well, and that's why we refer to it as the complete package here.
And David, you made a convincing case there, but before I pile in, how would you explain downside risks to this one?
Yeah, it's a good question. So everyone's going to be hit in some kind of a consumer slowdown, right? We do think Walmart is well insulated here. They've got the tariff offset, plus you've got more than 60% of the business relates to grocery consumables type items. So more non-discretionary. So you've got a good core base there. But if sales were to slow, they'll get hit like everyone else. We think they'll have relatively better numbers, but we frame the downside scenario for Walmart at about $75 per share. And that's as you get sales to slow a bit, but you've also got these margin offsets and these accretive pieces of the business that aren't fully tied to the macro, somewhat secular, just given their early stage growth stories.
So you like Walmart, David. Let's also talk about Costco. That one, you're lukewarm on that one. Looks like you had a neutral rating there. And it sounds like valuation is a concern for you.
Exactly. So a couple things here. Great company. We don't think it's a great stock just because of where it's this setup here. And you've got a consumer name trading at almost 50 times earnings. So that's a big number. Walmart's in the mid 30s, also a big number, but relatively better. And so Costco, incredible operator, their execution has been nothing short of stellar in our view. You've got these mid-single digit consistent comp numbers each and every month. And no one's really putting that up across the consumer space. But our concerns here is they do have an ads business, very similar to Walmart, but we think management has a different intention here, where you won't see all of the upside flow through to the bottom line. And in quintessential fashion, Costco puts that upside back into the member experience. So lower prices, better rewards, and then that's probably the right thing to do to protect your sales base. But we think investors are expecting a little more on the flow through, and then just the valuation piece. If you potentially have a business that's set up with all these investments to have a higher leverage point, and what I mean by that is you need mid-single digit or high single digit sales in order to get margins higher. If you have that set up going into a potentially slowing macro environment, we just think that's difficult to underwrite 50 times earnings on.
And Dave, final ticker I want your take on, Target. Now that one you're neutral as well. So why are you on the sidelines there, David? And what would you need to see before getting more constructive?
Yeah, this is big. Target has massive upside potential here, right? You're talking about a stock in the mid 90s or so. Margins have been pressured. They've had slowing comp sales. We think that's a function somewhat of what Walmart has been doing with delivery and convenience and getting that customer who wants to order online. And then you've also had inventory shrink. So they have not fully fixed this. You still have a lot of product that's locked up in stores, and that's keeping a lid on the margin rate at this point. But what we'd like to see is, discretionary is a big piece of this business. Almost half of the product base, half of the sales base leans more discretionary for Target. And that's where we haven't seen the recovery just yet. Apparel, home decor, electronics. So if you start to see a shift there, that'll definitely help the Target profit recovery story. As we look at this today with all the tariffs flying around and about 50% of their products sourced overseas, we actually see some downside risk to near-term numbers for Target.
David, appreciate your time and those stock picks. Thank you.
Thanks, Josh.
I want to welcome in now Simeon Hyman, ProShares Global Investment Strategist, as well as Brian Levitt, Invesco Global Market Strategist. Guys, welcome to you both. Brian, I'll start with you. It looks a little relatively calmer out there, right, as Jared was just saying today. Not just the popular averages, but 10-year Treasury, Brian, we're holding steady here at 4.33. VIX has tumbled, the dollar firmer. What do you make of it?
It feels a little bit like where we were before Liberation Day, where everybody thought we may start to get better outcomes with regards to the trade conflict. So I think as soon as we put a pause in place, the expectation was maybe we've seen the worst of it. And we probably have seen the worst of it in terms of where tariffs go. Of course, tit for tat conflict with China could continue. But that's becoming more of the perception. My concern is the longer this is in place, the longer the uncertainty persists. Obviously, the bigger the hit to sentiment, the bigger the hit to investment. I don't think it's a market that's priced for recession. So that's the challenge. Hopefully, we will get better news, but we're all a bit on the whims of the White House right now more than we typically are.
Simeon, let me ask you, I want to get your take on the earnings picture as well, because we got more big banks reporting this morning at Bank of America, Citi. I mean, both those names are higher in today's trade. We'll talk to an analyst later about those names. But kind of just bigger picture, Simeon, I'm just curious what you've made of the earnings season so far, lessons learned, obviously with big tech still on deck.
Well, first let's put it in context. And the context I like is, let's skip over the great financial crisis because there's so many other moving parts. Let's go back to the turn of the century when we had a downturn that was after a long period of tech outperformance. Here's a couple of points of comparison. We were at 30 PE then. We're at a 22 PE now. But 10-year bond was 6.5 then. So apples to apples, it's almost like 13 versus 15, 16. So valuation's more attractive. And very specific to the earnings point, take the tech sector. The price to book is the same as it was 25 years ago, but the PE's cut in half. That means that the tech sector is generating double the amount of earnings per dollar of book value. So we're coming for some pretty strong fundamentals. And earnings season, we know it's rear view mirror, but it's coming in okay, not bad at all.
Is that your take, Brian, as well? Okay?
Yeah, it's certainly coming in okay. I mean, we'll have to see. We want to see what the guidance looks like, and I think a lot of these CEOs and CFOs are a little bit challenged on that.
Are you surprised on that point, though, that big banks, they weren't like pulling There was fear that we would hear more CEOs just say, or CFOs saying, listen, I'm pulling guidance. I can't give you a forecast.
Yeah, I'm somewhat surprised, but I suppose I mean, you have to remember the economic setup was quite good. Coming into the year. The U.S. economy was in a good place, inflation was stable, Europe was coming on, so we were in a better place. A lot of animal spirits, still looking ahead to what deregulation could mean, to what tax cuts could mean, but yeah, we're in a bit of a challenge here. I am a little bit surprised that more didn't pull, but more more on the industrial side, more on the manufacturing side. I think the challenges are going to persist.
I want to get the same question to you about earnings. When you think about corporate profit growth, Brian, in 2025, what does it look like to you?
Well, I think it moderates. I mean, I don't think that we're going into negative, a negative growth area, but it's certainly going to moderate. I mean, look, the reality about tariffs is you may say there's a rationale for it, but somebody has to pay for it, right? So it's either going to be a hit to corporate profitability, or it's going to be passed on to the consumer, or in a worst case scenario, both. So we have to imagine that. I mean, leading indicators are pointing towards slower growth. It's going to result in slower corporate profitability. And, again, the market is assessing what that hit is. Are we heading into a recession? We certainly hope not, but policy mistakes, if left in place long enough, can get you there.
Against that backdrop, Brian, I'm curious, in the equity market, what sectors look attractive to you? And have you kind of shifted given all the tariff and policy
I would still be defensive here. In an environment where leading indicators are still...
And does that mean staples, healthcare?
Yeah, I mean, I would think more, if I think about it from the factor level, I would think more higher quality businesses. I'd also look quality and adding some value into the portfolio rather than.
When you say quality, Brian, how do you screen for quality? What does that mean to you?
Well, I'm thinking about cash flow generators, companies that don't have impaired balance sheets, that don't have to roll debt in the near term. I mean, I think it's less about sectors right now and more about what type of factors we want to be exposed to. And so, what I think is important for investors, coming into the year, the hope was we're going to have a broader market, right? And the idea of a broader market was better nominal growth in the U.S. and around the world. And as a result of that, a little bit more value, a little bit more mid-cap, a little bit more Europe. And the reality is that worked, but not the way everybody anticipated it would work. It worked with some of the highest concentration names, highest valuation names coming down more. What's nice about that trade and why I think it makes sense in a portfolio is if the economy rolls over more, you're coming at it from a lower valuation perspective. If we get the recovery, those are the types of markets that tend to outperform in a recovery.
And Simeon, I think last time we spoke, I asked you where you saw opportunity. I think you were sticking with those sort of dividend growth strategies.
Couldn't agree more with the quality point. And for us, an easy way to capture quality are consistent dividend growers. The S&P 500 Dividend Aristocrats, it's our ETF, NOBL, Noble. These are companies that have grown their dividends for 25 straight years. That means they grew their dividends in the great financial crisis, if that's just one proof point for you. And it fits the sector composition. You've got more staples, less technology. They've been underperforming because of the tech run for the last couple of years, and they've got all the things that you mentioned, strong balance sheets, cash flow generation. So that's certainly one way to capture the quality idea.
That's what you like, Simeon. I'm curious what you would avoid here. What doesn't look as attractive?
Well, look, there's a simple one. Energy. At some point, you've got to do the counter-cyclical. You buy it when oil is dirt cheap, but we're still on the cusp of a falling bit of demand here. So that's an easy one. And by the way, look, it's only 3 or 4% of the S&P 500. So it's not like if you're nervous about technology, taking it to zero is too extreme. But you could take energy to zero, it's 3 or 4%. And if you're right, you're going to outperform the S&P by 100 bips. And if you're wrong, you're going to underperform. So it's a prudent thing to avoid.
We went into this whole interview, Brian. I didn't even ask your outlook on the Fed. What do you think Jay Powell does this year?
I think the Federal Reserve is going to bring rates down gradually. I think the most important thing is I think they're ready to respond if there's disruption in the bond market. And clearly the administration seemed willing to respond. And that goes back to the old Carville line about I want to come back as the bond market so I can intimidate everyone.
Right.
I mean, we certainly, I personally would rather come back as Tom Brady or Mick Jagger, but so be it. So we've seen the response. I think the Federal Reserve is going to look through, we're going to have inflation in the near term. I think they're going to look through the price shock if growth deteriorates and if there's disruption in the bond market. The reason for that, I mean, it's the reason why they've always used core when looking at inflation data, because they don't want to respond to price shocks. They want to make a determination on what long-term inflation expectations are going to be. Long-term inflation expectations, at least if you look in the bond market, very contained, which gives them the ability to move as growth slows. Now, do they solve all of our problems for us this time? I mean, they probably give a market boost, but I don't know they solve our problems. We really need to see the clarity come on the trade side.
What do you make of that call, Simeon?
It was very comforting to see some stability on the long end of the curve, for as much as any other reason, because what this does is it allows us to continue to view bonds, longer duration bonds, as being in a position to diversify equity risk. We haven't had that opportunity in a generation because quantitative easing brought yields down so low that in 2022, bonds couldn't bail out stocks. From 4.5% 10-year, the idea is if we have a recession, then we'll have 2.5%, 3% on the 10-year, and you make 10% on the ag. And it looks like that will hold for now.
Treasury yields are rising this morning as investors weigh Fed Chair Jerome Powell's concerns about the state of the economy and amid President Trump's tariff rollout. Powell warned of the challenging impacts of tariff uncertainty to the economy, but says the Fed is in a wait-and-see mode.
We are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks.
President Trump once again criticizing Powell, saying that the Fed is too late and should have already lowered interest rates. Is the Fed behind the ball? Joining us on set is Blake Wynn, head of U.S. rate strategy at RBC Capital Markets. Great to have you on set as always here, Blake, and good morning to you. So, is the Fed behind the eight ball, or is that more so political posturing from the administration right now amid what the markets are seeing as a self-induced hit to the economy right now?
Well, in which direction do you mean? Because we have risks on both sides. I mean, we could find out in 6 months that they're actually behind the curve on inflation, or we could find out that they're 6 months behind the curve on, downside risks. So I think that's the problem facing the Fed. I mean, the analogy that I've been kind of using with clients, it reminds me of a goalkeeper in soccer kind of defending against a penalty kick. You don't know which way the ball's going to go. It could go to the inflation side, upside inflation risk. It could go to the downside on labor, thinking about their dual mandates. So if you preemptively jump in one direction before you see where the ball's headed, maybe you guess the right direction and you save it, or you end up very offsides to try to save it in the other direction. So Powell just wants to see which way that ball's headed before they actually start to react.
I'll just note that you sent that graphic to our team here, and I think it's probably one of the first times that we've received a meme-type graphic from RBC, so we appreciate that as well here.
Yeah, we certainly do appreciate the references to Ferris Bueller, the goalie references, but I am curious, Blake, because you had updated your guidance to 3 rate cuts this year prior to Powell's commentary. I just asked you, has that changed since he spoke? You said no. How much damage do you anticipate happening to the economy to justify 3 cuts this year, given Powell's commentary about not being in a rush?
Yeah, and I think there's kind of 2 fronts that we've been thinking about this on. One is the actual impact from whatever tariffs end up being in place over the next 6 months to a year, right? Mm-hmm. So you have the actual drag that's coming from that. And if you look at that, there's huge amounts of uncertainty. We have no idea where it's going, but we have to make some kind of base case. And I think it's very, very clear that that base case is worse for us than it was 2 months ago. Even with the pause, I mean, we're looking at an effective tariff rate that's still the highest we've had in 100 years, right? So that's going to drag. I think the second piece, and I think Josh really hit on this very well, right, to focus on the uncertainty, there's the impact of the tariff itself, but then there's the uncertainty that this is causing. So even if you may not be directly impacted by a tariff that's in place right now, are you buying new equipment? Are you hiring new people? Are you leasing new land, expanding your business? Yeah. And I think that's toothpaste that's very hard to put back in the tube. You've rung that bell, the uncertainty is there, you've injected it into the psyche of C-suites and consumers. Right. It's very hard to unring that bell.
To that exact point, I want to talk about the Philadelphia Fed survey from this morning. This is obviously only one region, but some of the data in here really jarring. Prices paid soaring, employment way down from previous levels, new orders in the negative, way below previous levels as well. Again, obviously just one region, but to what extent is that an indication of data that could show up in the hard data that the Fed looks at sooner rather than later?
That is the question, and I think when Powell says he's wait and see, what we're waiting to see is if all of the negative sentiment that's been showing up everywhere, I mean, it's in all the consumer surveys, all the business surveys, for several months now have been showing that there's a huge amount of uncertainty on tariffs specifically, but even around some of the DOGE stuff, the cuts as well. The real question is, how is that going to cross over into the hard data? And I think that's a difficult question right now because we have had a period over the last few years where the soft data, the survey data, has not really matched up with the hard data. Yeah. And that has persisted for a while. So usually you would look at the soft data and say that's a leading indicator. You know, if people are very down on the economy, they're going to behave in a way that ends up dragging on the hard data. But given that that didn't really happen very much over the last few years, I think it's right to be somewhat doubtful if that's going to happen. But that's what we're waiting to see, is the downside that has been very clear in the survey and the soft data. Is it going to cross over into the actual activity data? I think March is too early. It's not going to be in the March data. We need to wait until that April-May data to see that really starting to build.
And so how would what you're seeing in the data also then go and influence your modeling for rates right now and kind of over the next perhaps 3 to 6 months for investors out here who are trying to look out into the future and best figure out, okay, where that rate strategy should influence their investment decisions as well on the back end of that?
So the hard part about the rate outlook right now too is that you have a lot of uncertainty at, let's call it a 1 month time horizon. I feel much more confident about a 3 to 6 month horizon, right?
Yeah.
Because there's just so much noise right now. There's a lot of volatility. There's a lot of positioning that's been shifting around that has caused some of the volatility we've seen over the last 2 weeks. So I feel very unsure about where things are headed over a 1 week, 2 week type of time frame. But I feel more confident that if we're talking kind of 3 to 6 months, that those downside risks, that crossover from the soft data to the hard data is going to happen, and that is going to start to pull yields lower. I also think that probably comes with a bit of curve steepening, because I think that's more in cuts being priced in the front end, whereas the back end, we still have some of these concerns around term premium, around supplies, deficit. You've heard rumors of foreigners selling assets. So I think that's probably going to keep the back end from kind of performing in the same way as the front end. So we get a little bit of that curve steepening. Yields come lower, but it is with a bit of a steeper curve.
Continuing on that, I'm curious your thoughts on the safe haven status of U.S. Treasury bonds, especially in the context of President Trump posting about a potential termination of Fed Chair Jay Powell. Unclear if he was talking about when his term is up or a more immediate termination here. To what extent does a statement like that and also the policy uncertainty from Washington put the safe haven status of the U.S. at risk?
Yeah, I mean, the way I've been kind of talking about is the stability premium that we've enjoyed for a very long time is in question right now. But I've generally been a bit of a seller of this theme because it's tough to figure out where you go. I mean, there are network effects to owning treasuries. I mean, treasuries are still where the liquidity is. It's a very, very deep pool of assets. There's no other foreign sovereign bond market that could absorb the kind of flows the Treasury does. And it's very hard to move away from. I've actually been likening it to the move away from Twitter. I mean, multiple times we've heard people say, we're going to Blue Sky, we're going to Threads. It just never quite seems to happen because you get over there and realize that nobody else is over there. And so it's just very hard to pull away from treasuries in any large way. Now, I think over the next few years, that's going to be a theme that we watch very, very closely. And I do think on the margin, these long overweights that people have held in U.S. assets may start to level out a bit. Like I said, I'm a bit of a seller of that, but even marginal moves, if you have a global bond portfolio and you go from 40% U.S. Treasuries to 35%, if a lot of people do that, it could still be pretty meaningful. So definitely a theme we'll be watching.
Blake, great to see you this morning. Thanks so much for taking the time here with us on set.
President Trump saying on Truth Social this morning that trade negotiations with representatives from Japan and Mexico were, quote, productive. The White House set to meet with the Italian prime minister today as well. As the negotiations continue, how big of a global risk is presented by the trade war? Here to discuss, we've got Fabio Natalucci, Anderson Institute for Finance and Economics CEO. He was previously at the IMF, where he managed the Global Financial Stability Report, prior to that at the Fed and the Treasury. So you could call you the perfect voice to speak with about the risks of global trade issues. Fabio, thank you for making the time. If you were still working on this global financial stability report, how would you characterize the risks presented by the way that these tariffs have been rolled out by the administration?
Yeah, thank you. First of all, thanks for having me on the show. I'm actually glad I don't have to write that report now, because I think we'll be rewriting that report several times up to the last minute. I think the point to start from the beginning of the analysis would be that the shock is different this time. Compared to the financial crisis, COVID, the war in Ukraine, this is essentially a policy-driven shock that intend to rewrite the global order and financial order. And so it's a stagflationary shock for the US, so lower growth and higher inflation, and at the same time, a negative shock demand for the rest of the world. And what matters here is also, first of all, the size of the shock, right? This is a very, very large shock. Even with the 90-day pause, it's a very large shock. And then the question is like, what do we know at this point? And when you consider hard data versus soft data, and how much faith you, in some sense, put on the soft data. There's a lot of survey out there that point to deterioration in sentiment, both consumer as well as businesses, whether this is the University of Michigan Conference Board. I think the crucial part is how to think about the uncertainty here. Uncertainty is like very big drag on both businesses. They can front run the business now, maybe run down inventories later, but they will be freezing investment and employment decision.
Yeah.
And then what about that's a risk of the supply chain disruption? There's some sign that this could be the next risk. And then consumer, we have tariffs essentially are a very significant tax increase to consumer. There's been a negative wealth effect from decline in equity prices. So it's very hard to model uncertainty. That's, I think, one lesson.
So Fabio,
I think what the Fed would be,
Fabio, sorry to interrupt you, but what changes this stagflationary shock to a recessionary one?
So I think it's going to be a point of how deep, if there is a slowdown, how significant that slowdown is. If it's a significant slowdown, there will be, in some sense, an offsetting of the upward pressure on prices, right? And this is what Europe is facing now, slower growth and inflation that is slowing. That allows central bank to cut interest rate. That's what we have seen the ECB has done today. The Fed, I think, is in a much more difficult spot. And Chair Powell yesterday was very clear that you can have two conflicting objectives. If inflation moves away from the target and if the unemployment goes up, then you need to use this balanced approach to measure how far are you from the objective. It makes their job much more difficult. And it's going to be a function of the size, I think, of the tariffs ultimately after the negotiation, as well as a function of the duration of these tariffs. How long they're going to stay high, how high they will be, will they come down on? And ultimately, I think it's going to be bringing certainty into the process. I think market participants can deal with certainty. If you know that the tariffs will be higher, you can rebuild supply chain, you can plan, you can invest. A big drag now is the uncertainty. You don't know what the end game is going to be here.
Right.
And that's what's the big drag.
So Fabio, I want to bring in Stuart Kaiser with Citi. He's still with us. Stuart, you got a question?
Yeah, Fabio, my question for you would be on the central bank side of things. Would you expect this shock to force the banks to coordinate more? Or do you think, the different impacts in different regions might, get the central banks kind of moving in different directions? How would you think about that?
I think that the tendency would be the central bank to move in different direction, right? If you listen to Chair Powell yesterday and see what the ECB decision has been today, similar would be for other central bank. In some sense, they have a much easier job. If both economy and inflation slows, the response is the traditional response. You just ease monetary policy. The Fed, for the tension for the Fed is that you have these two conflicting objectives, and you're going to start see some of those tension, I think, on interest rates, right? You just see now the long end of the curve in the US moving higher in the last few days, even though they come down now, but you would expect rates in some of these other countries to actually go down. And then from rates, you go to the exchange rate. And that's, I think, what we're seeing that is very unusual in the behavior of the dollar. Usually when you have risk assets down, and rates move, particularly if rates move higher because it's an inflationary shock, you would expect the dollar to appreciate. Those were the expectation in the end of last fall. Or you see a very different behavior of the dollar, and that's what raises this concern, whether this is about fiscal concern, whether this is about foreigners trying to reprice dollar asset with a higher risk premium because of all the uncertainty here in the US.
And Taiwan Semiconductor Manufacturing Co. is projecting confidence in the face of tariff-driven pressure, leaving its full-year growth outlook unchanged. The Taiwanese chipmaker had a robust first quarter, topping analyst estimates with a 60% year-over-year net income increase. The report comes after new U.S. export controls roiled NVIDIA and the broader chip sector on Wednesday. Here we've got Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. Patrick, always great to speak with you here. Talk to me about your big takeaways from this TSMC print, given the fact that it's being seen as such a bellwether in an industry for tech that took a huge hit in markets on Wednesday.
Yeah, zero surprises for me. I mean, essentially, this is all dependent on this Mag 7 CapEx build out. And it's not that Apple isn't relevant in this scenario, but Apple got a reprieve on the tariff situation. So that's looking pretty good. TSMC, while they didn't use the word sold out, they are essentially sold out for 2025 leading edge wafers. And regardless of the ebbs and the flows right now, this continues. But, all bets are off if we see big tariffs in semiconductors or reinstitution of the smartphone and PC tariffs that were that went away last week.
Patrick, I was running some charts this morning, just looking at the gross margins that have become a little bit normalized and steadily grown for TSMC. And that's even with the introduction and increasing talk and investments around some potential competitors in the future. But it really kind of solidifies how much they are the de facto type of play here. Even with potential competition in the future, are these margins attainable over a longer term period of time? We're talking levels between and the mid kind of 55%. I think the average is at about 57% gross margin for this company. Is that something that's able to be replicated even with the entrance of new competition in the space?
Yeah, so TSMC margins are obscene or obscenely awesome, depending on which lens you want to look at. And there's talks of a 30% price increase in the U.S. And right now, they're essentially testing their ability to raise prices. And what TSMC will say is that we need this money to go in and do some massive capex, but with profits raising and capex raising at the same time, it doesn't look like this. I think this opens the door for companies like Intel, for companies like Samsung to take some high-end market share away from TSMC. I would put 100% chance that on a percentage basis, TSMC loses market share. All it takes is Intel or Samsung to get one major customer, and this will happen.
Just very quickly, Patrick, a follow-up regarding TSMC amid the Trump administration. What is the potential headwind that this company could be facing? Because they've already been threatened with more tariffs or taxes, rather, if they don't produce in the U.S.
So I think you nailed it right there. I mean, the biggest headwind they have is the threat of tariffs. The second would be if the U.S. economy or the global economy goes into a recession, and that puts pressure on the Mag 7 CapEx, which then reduces the amount of those high-end GPUs and high-end CPUs and accelerators that are driving this economy today.
Super quick, Patrick, to what extent do you foresee TSMC's results this morning impacting Apple moving forward?
So I don't think it impacts Apple at all at this point. Again, TSMC's forecasts were based on no huge changes in Apple business. That could change with a tweet. It could change with an executive order on any changes to not only semiconductor tariffs, but also devices that come out of China that would dramatically and very negatively impact Apple.
Yeah, and Patrick, I'd be remiss to not talk to you about NVIDIA. NVIDIA taking a $5.5 billion hit due to export controls, the stock dropping significantly off the back of that, just barely above the flat line today. CEO Jensen Huang is in Beijing, according to state media. Right. Talk to me about what this tit for tat over tariffs means for NVIDIA. Just how big a headwind is it for NVIDIA to be able to beat the street's sky high estimates moving forward?
Yeah, so H20, while a $5.5 billion write-off is not zero, I think the biggest risk here is if this escalates. And with NVIDIA, Intel, and AMD doing between 20 and 30% of their business inside of China, that's the biggest threat, that it escalates and gets into not just data center accelerators, but also notebook GPUs, gaming GPUs, CPUs from AMD and Intel.
And so with that in mind, at this juncture, for investors that are trying to best game out what they're seeing actually in some of the options AI market as well, I mean, this is a potential 11% move to the upside or downside by this next time NVIDIA reports earnings. What should they be kind of looking at as either a psychological marker or perhaps a technical marker that determines whether or not this is a safe level to invest?
Yeah, I think looking at the psychological marker, which is, and not too many people are talking about this, I think the Trump administration has painted itself into a little bit of corner and is trying to find a way to get out of this because they know that if you bring down Apple, you bring down NVIDIA, you're tanking the market. So I feel pretty confident over the next 90 days that this is going to be resolved. I think it'll be hard for NVIDIA to give a rock solid forecast, but I do think that they will give one based on the information they know. And then out the other side of their mouth, they're going to say, these are the risks of that forecast.
So then, Patrick, which chip's name should investors who have a long-term horizon be investing in right now?
Long-term horizon, 5 years, I believe that the best bet is Intel. And that might come as a surprise to everybody out there, but it's trading near book value. Its 18A and 14A process are on schedule. We're going to continue to have a push on U.S. company, U.S.-built semiconductors. All Intel has to do is hit a couple of not home runs, just getting to second base, and you're going to see Intel move a ton. And also, Lip-Bu Tan, we haven't seen any of the big decisions that he's made yet as a new CEO. And I think whatever he puts out there, whether it's massive job cuts, R&D cuts, sale of assets, he just unloaded Altera. I think these will be positive news for investors with Intel.
Yeah, I was just about to acknowledge that, Patrick. It's a larger question of how much of the business as we know it right now is still intact, or if there's a kind of sum of parts that we're going to be looking at in the future. Right. Patrick, as always, thanks so much for taking the time.
Thank you.